Assalamualaikum warahmatullahi wabarakatuh. On this occasion, we will explain about analyzing financial performance reports. We are from Group 5. Me, Nabila Tazkira Madita, and my partners Miftahul Jannah and Rahma Ekwatrin Prahastuti. This chapter focuses on analyzing financial performance measures. The first part is calculating variance. Describe how variance between actual and budgeted data are calculated for business units. The second part is variations in practice. Describe how reports of this variance are used by senior management to evaluate business unit performance. And the last part is limitations of variance analysis. Describe how non-financial performance measures can be incorporated into the management control process. In this video, we will explain about variations in practice and limitations of variance analysis. Variations in practice. There are some variations that will be explained. Time period of the comparison, focus on gross margin, evaluation standard, full cost system, and amount of detail. Time period of the comparison. A comparison for the year to date is not as much influenced by temporary aberration that may be peculiar to the current month. Therefore, that need not be of as much concern to management. On the other hand, it may mask the emergence of an important factor that is not temporary. A comparison of the annual budget with current expectation of actual performance for the whole year shows how closely the business unit manager expects to meet the annual profit target. If performance for the year to date is worse than the budget for the year to date, it is possible that the deficit will be overcome in the remaining months. On the other hand, forces that cause actual performance to be below budget for the year to date may be expected to continue for the remainder of the year, which will make the final number significantly different from the budgeted amounts. Obtaining a realistic estimate is difficult. Business unit managers tend to be optimistic about their ability to perform in the remaining months, because if they are pessimistic, this casts doubt on their ability to manage. To some extent, this tendency can be overcome by placing the burden of proof on business unit managers to show that the current trends in value, margins, and costs are not going to continue. The next variation is focus on gross margin. Assume that selling prices were budgeted to remain constant throughout the year. In many companies, changes in cost or other factors are expected to lead to changes in selling prices, and the task of the marketing manager is to obtain a budgeted gross margin. There is a constant spread between cost and selling prices. Such a policy is especially important in periods of inflation. A variance analysis in such a system would not have a selling price variance. Instead, there will be a gross margin variance. Unit gross margin is the difference between selling prices and manufacturing costs. The variance analysis is done by substituting gross margin for selling price in the revenue equations. Gross margin is the difference between actual selling prices and the standard manufacturing cost. The current standard manufacturing cost should take into account changes in manufacturing costs that are caused by changes in wage rates and in material prices. The standard, rather than actual, cost is used so that manufacturing inefficiencies do not affect the performance of the marketing organizations. And the next presentation will be explained by Miftah.
And now, I will continue to explain about the evaluation standards. In a management control system, a formal standard is used in the evaluation of reports on actual activities, and evaluation standards consist of three types, namely, the first is predefined standards or budget. This standard is the basis against which the actual performance is compared on many companies. Actually, when carefully prepared and coordinated, it is a superior standard. The second is historical standards. This is an actual past performance log. The results of the current month can be compared with the results of the previous month. This type of standard has two serious drawbacks. The first is conditions may change between the two periods in such a way that the comparison becomes invalid. And the second, the performance of the previous period may not be acceptable. And the last is external standards. This is a standard that is derived from the performance of other responsibility centers or other companies in the same industry. The performance of one sales branch can be compared with the performance of another sales branch. In addition, it can also identify other companies that are believed to be the companies with the best management in the industry. And next, I will explain about full fee system. If the firm has a full cost system, both variable and fixed overhead costs are included in inventory at standard cost per unit. If the ending inventory is higher than the beginning inventory, part of the fixed overhead costs incurred during the period will remain in inventory rather than flow to cost of goods sold. Conversely, in the inventory balance decreases during the period, more fixed overhead costs are released to cost of goods sold than the actual amount that occurred in the period. If the company has a variable cost system, fixed production costs are not included in the inventory, so there is no variance in production volume. The important point is that production variance should be related to the volume of production, not to the volume of sales. That's all from me. Thank you.
Okay, the next I will explain about the engineered and discretionary cost. A favorable variance in engineered cost is usually an indication of good performance. The lower the cost, the better the performance. The performance of a discretionary expense center is usually judged to be satisfactory if actual expenses are about equal to the budgeted amount, neither higher or lower. The next is about limitation of variance analysis. Although variance analysis is a powerful tool, it does have limitation. The most important limitation is that although it identifies where a variance occurs, it does not tell why the variance occurs or what is being done about it. A second problem in variance analysis is to decide whether a variance is significant. Statistical techniques can be used to determine whether there is a significant difference between actual and standard performance for certain processes. These techniques are usually referred to as statistical quality control. A third limitation of variance analysis is that as the performance reports become more highly aggregate, offsetting variance might mislead the reader. The reports show only what has happened. They do not show the future effects of action that the manager has taken. The next is about amount of detail. In the example, we analyze revenue variance at several levels. First, in total, then by volume, mix, and price. Then, by analyzing the volume and make variance by industry volume and market share. At each of these level, we analyze the variance by individual products. The process of going from one level to another is often referred to as peeling the onion. That is, successive layers are peeled off, and the process continues as long as the additional detail is judged to be worthwhile. So I think that's from our group. Thank you. Wassalamualaikum warahmatullahi wabarakatuh.